episode 1 of Paul2's PowerPoint presentation screen recordings featuring information about cryptocurrencies, mostly DAOs and public goods, and Web3 and whatnot. Sponsored by the U.S. Department of Treasury. Would like to remind you that no, you cannot borrow a printer. That's me. I'm Paul2. You probably already know me from Twitter, where I have hundreds of followers. I am a full-time DAO contributor, and I focus on DAOs for public goods because public goods are not handled well by our current economic system, and that's something that DAOs are especially well suited to fix. Most of my time goes towards One Hive and Gardens. I also pay a lot of attention to Gitcoin and Common Stack. Those are very good projects in the DAO for public goods space. I am a certified crypto expert. This is my degree. I'll just leave the certification up in the top right so you can see it. Today, we're going to talk about degenerate apes on decentralized exchanges. On a centralized exchange, you have a buyer and a seller and a way of coordinating a trade between the two of them. A crucial difference about a decentralized exchange is that you don't need to coordinate the buyer and seller. You can trade directly with a liquidity pool. How does that work? I am so glad you asked because now I get to show you this cool spreadsheet I made. This is a sample liquidity pool for one trading pair, USDC and Muffin Top. Muffin Top is a collateralized token. It's backed by the tops of muffins. In the liquidity pool, we have two piles of tokens, USDC and Muffin Top, and the total liquidity is the total dollar value of both of those piles. The price of a token is simply the ratio of one pile to another, and that will become a little more clear when I show you a trade. So here's my wallet, and if I want to buy one Muffin Top, I'll take a USDC from my wallet, put it in the USDC pile, and take out a Muffin Top from the Muffin Top pile. Boom. I just made a trade all by myself, no seller involved. But the price of Muffin Top went up, and it went up quite a bit because we don't have much liquidity in this pool. So let's add liquidity. And when you add liquidity, you do that at the same price, meaning the dollar values of the tokens that you're putting in must be equal. In this case, we have $4 of USDC and $4 of Muffin Top, which is 3 tokens at its current price. And now we've added, how much did we add? We added $10 of liquidity while maintaining that price. And now I own a portion of the liquidity pool, which means that I will get a portion of the transaction fees that traders make on this pool from now on. And now that we have more liquidity, the next time someone trades here, the price slippage won't be quite so bad. So, everything in life has peaches and pits. And on decentralized exchanges, there's a lot of peaches. Not only did we not need to match a buyer and a seller, we don't need anyone's help to add our token to the exchange. If you have a token and you can provide liquidity for it, then it's a freely tradable token. And last, liquidity is not based on transaction volume like it is on a centralized exchange where you need to coordinate buyers and sellers. You can have healthy liquid markets for low volume financial assets. The pit with all this is that you've got to have some fat stacks of money that you can put in a liquidity pool, or you need to incentivize other people to put their money in a liquidity pool. Basically, instead of liquidity by volume, you're doing liquidity by sheer stacks of cash. At this point, I've said the word liquidity so much that it's starting to sound weird. Liquidity, liquidity, liquidity. What does it mean? Moving on. Here's a liquidity pool. And let's say that this is your liquidity pool and you want to incentivize people to put their money into it. What are you going to do? You're going to buy some Juanitas. You're going to get some bitchin' sauce. Probably some Michelob Ultras. maybe even a live acoustic Cat Stevens set. You got to break out all the stops. You got to get some liquidity. And this will definitely incentivize people to come to your pool, but you're not only going to get people at your pool, you're going to get absolute degen apes also. And I have a cautionary tale about this. It's called Iron Finance. Iron Finance is a hybrid stablecoin, and by that it means that it's partially collateralized and partially algorithmically controlled, like MakerDAO. And this is an interesting enough concept that maybe if it had been introduced to the world as a public good through a Gitcoin grant, there might have been some interesting discussion about the usefulness of that. But instead, it was introduced to the world on Binance with very attractive liquidity incentives. This made it successful with a very specific species of primate, which followed it along to Polygon, where it launched in May. If you went onto Iron's website not long after it launched on Polygon, you would have seen this. These are its liquidity pools and the APRs that you would get for providing liquidity. These are paid out in Titan token. That's the Iron Finance governance token. So most people are going to look at this and they're going to think, this is absolutely raising a million red flags. There's no way that you can healthily get these kind of APRs. But at the same time, like, what if I just put in $1,000 and then just take out the interest as soon as I get it, and then if there's any issue, I'll pull out my liquidity right away. And then once you start getting the APRs, then you can't stop. You got to put more money in, and then it keeps working, and then you got to put more money in. Well, it turns out a lot of people did something similar, and the value locked in Iron went up quite a bit in a very short amount of time, and then went down quite a bit in a very short amount of time. On the morning of June 16th, there was over $2 billion locked in Iron Finance, and by the end of June 16th, without any hack or rug pull, they were sending out a tweet about a post-mortem. You might as well not even read the post-mortem report, though, because it doesn't mention the number one reason this happened, which is that 100% of the money was provided by degenerate apes with Mercenary Capital. They were putting their money in to get yield, and they were going to take it out as soon as they stopped getting these incentives. Mercenary Capital. These people aren't thinking, oh wow, how great would the world be if we just had a partially algorithmic stablecoin? No. They're thinking, where's my yield? I need it. I wish I had a real keyboard so it would, like, sound more dramatic. These are apes. Absolute apes. And I know this because I was one of them. And that's what I was thinking. I was trying to get that yield. Know what I'm saying? So what have we learned? Apes are going to ape. And I don't mean that as an indictment of apes. I'm not going to indict myself. I just mean if you are incentivizing liquidity, then it would behoove you to make sure that your incentives are not attracting mercenary capital, because it's not going to last very long. So the challenge is incentivizing liquidity in a way that's sustainable in the long term. And if this interests you as a challenge, then you should go to the OneHive Discord and check in with the Tulip channel, because you will find people that are very happy to talk to you about this. That's it. That's all I have. Thanks for watching. See you again soon.